Thank you for tuning in to Investment Insight presented by McCay Wealth Advisory. My name is Hayden Proffitt. Joining us today, we have Brent McCay from McCay Wealth Advisory. Brent, question we've gotten a lot about this year, and probably not in your era, more in your era, not CD-ROMs, but certificate of deposits, CDs. So we've gotten a lot of questions about those this year because they've been so attractive, so to speak.
So obviously, when the Federal Reserve raises interest rates, that tends to lead, that means there's higher inflation. And so when there's higher inflation, CDs typically in cash products, we're going to mirror inflation. Right. So yes, they don't tend to make a lot of money, but they do mirror inflation. So people are like, hey, I'm getting 10% on a CD. Well, that's probably pretty terrible because that probably means inflation is 10% a year. And remember, if you're making 10% a year and you're paying 20% taxes, you're actually losing money after taxes. But when we look at CDs and money markets, they are very attractive. Obviously, the advantage of a money market is it's liquid. Typically, it's cash. Now, one of the money market accounts I personally use for some funds, it limits me to 5 or 6 transactions a month in order not to incur a fee. But the idea is that the money's liquid. Now, the good thing about liquidity is it's liquid. You can get access to it. The bad thing about liquidity is when those rates go down, your rates will drop pretty much immediately. And and as we're taping this video, there's an expectation that there's going to be a rate drop this year, and that probably means those money market rates are going to be the first ones to start going down. So the banks are going to push people towards those because they're pricing in, a corporate, like a loan at 8.5%, and if they've got a money market at 5, and the rates immediately go down to 4, well, they just immediately made a bunch of money. Because that loan's still locked in for 5 years, where that money market's only locked in for today.
Right.
So that's a big difference between when you're looking at stuff.
And we also talked about a bank CD versus a brokerage
Correct.
CD. You talk about bond rates and how they fluctuate based on what you can get a bond at in the open market. And I'm using bond in terms of a CD. But, if bonds are in the open market trading higher than what yours is, then yours is at a discount, is selling a discount.
Yeah.
And with CDs, brokerage CDs are very similar in that aspect.
So a brokerage CD, so if you have a CD at a bank, because the bank insures the money that you hold the money with, then when you see your statement, it's going to say, hey, if you put 100 grand in, it's worth 100 grand. If rates go down, it's still going to say it's worth 100 grand. If rates go up, it's going to say it's worth 100 grand. Now, almost every bank we've seen, when you pull that early, they charge a penalty, but they don't reflect the penalty on your statement, which is a big deal. Because if you pull it out early, you're going to get less money than what that statement says, because you're going to get the penalty, the whatever interest you earned, and you're going to get your principal minus whatever that works out to be.
Right.
A brokerage CD is a little different because a brokerage CD has to account for market-to-market accounting, which means we have to have a reflection every day of what that CD could be worth. Just like your house. You buy a house for $200,000. Well, if you have to sell today, and you have to sell today no matter what, you're probably going to get less money.
Right.
Where if you can find a realtor, find somebody that looks at the house and really likes this house, then that's a different deal. And so brokerage CDs work the same way. You're going to get whatever the market thinks it's worth, but you don't know what it's worth until you sell it. Now, the benefit of that is if rates go down and you're locked in at a higher rate, so let's say you're getting 5% and rates are down to 4%, someone's going to pay you typically a premium for your CD. If you have a CD with a bank and the rates go down and you want your money, they're going to charge you a penalty, typically, to get a low rate. So you're going to lose in the end. If rates go up, they charge you a penalty, so you lose money. If rates go up with a brokered CD, the value will go down as well. And so that's what the difference is. But the nice thing about our stuff is you have a true reflection of what everything could be worth that day.
Right.
Which I like that. But it is a little bit different looking than when a customer looks at a CD and they say, hey, this thing hasn't moved ever. Why is this thing moving? Well, they're different type products.
Yeah. And another thing about like a brokerage CD that helps you out, if you do have excess cash in excess of the $250,000 FDIC limit, you can diversify across multiple banks?
Great point. So one of the big benefits, if I'm holding money with my local bank and I've got money in just my name, I've got FDIC coverage for $250,000 as of shooting this video just in my name. If I have $500,000 in just my name, $250 is not covered.
Right.
Obviously, if I had my wife on there, then I've got $500,000 in coverage. And so you can have a $250 in her name, $250 in my name, $500,000 in both of our names, and you'll get $1 million in FDIC in coverage. The benefit of brokerage CD, though, is we can use banks all over the country.
Right.
So say we get a CD for Wells Fargo, then we get a CD for Citigroup, then we get a CD for JP Morgan. Each CD has FDIC insurance. So one of the big benefits for us is most people, to get that coverage, they're going to have to run to every local bank, do accounts and do forms all the time. Whereas with us, I'm like, well, I'm going to buy that one, I'm going to buy that one, and it's basically a few clicks and you got FDIC coverage.
Right.
Which is a huge benefit with your time. And typically, since all these banks got to compete, you're going to get a better rate typically because you got the whole market competing. Where if you just go to one bank, you're going to get their rate.
Yeah, you're saying nationwide CDs, not just allocated to just even the state of Tennessee. We buy them all across the country.
Yeah.
And I think that helps us because we get a competitive rate.
And like you said,
for our customers.
And FDIC insurance. I was looking at a customer's account last week and he had $1 million in his checking account. That's not covered. Mm-hmm. And let's be honest, in the current political environment, they're probably more likely to penalize somebody with more money in an account than others. There was when we look at stuff, having that coverage is just so important.
Right.
Making sure your money is insured. Now remember, if you sell a CD early, you can lose money.
Sure.
And if you pull a CD out of the bank early, you can pay a penalty. So it does say, it's insured based on when it matures. Right. And that is a big difference to understand.
Right, for sure. And I think that's something that's important to understand is just the difference in between a brokerage CD and a bank CD.
Absolutely.
So, all right. Well, thank you for explaining the difference to both these to all of us. And thank you for tuning into Investment Insight. And I hope you have a great day.